Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at X Energy.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off.
Yeah, it's incredibly helpful. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android.
Exactly. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, safe screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets.
And Pro comes down to about $5.93 per month when billed annually after the discount.
Right. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list and comes down to about $14.93 per month when billed annually after the discount.
Just remember, stockanalysis.com is a research tool, not financial advice.
Yeah.
It does not tell you what to buy or sell, and it does not guarantee investment results.
Always do your own research and make your own investment decisions. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
So imagine trying to power, the entire next phase of the Industrial Revolution, only to realize the electrical grid you're plugging into is fundamentally maxed out.
Yeah, it's a massive bottleneck.
It is.
Yeah.
And that's exactly the reality of the artificial intelligence boom right now. It's fascinating watching a company transition from essentially this highly speculative science project into the potential savior of the global energy grid.
Right, and we're looking at an advanced nuclear developer right at that precipice today.
Exactly. Operating in the pre-commercial stage, the stakes are incredibly high, but the capital requirements and timelines are equally massive. Looking at the data we have, this feels a lot like the early days of the space race.
Oh, that's a really good way to put it.
Yeah, because we're seeing heavy government partnership up front, intense cash burn, all built on this promise of a massive commercial payoff a decade down the line. So how should investors weigh that immediate cash burn against a future promise that's so far out?
Well, that space race analogy is really the perfect lens for this, because the critical driver pushing this from pure R&D into a deployable asset is just raw demand.
Right.
Specifically, the insatiable multi-billion-dollar demand from hyperscale data centers. To quantify this for you, a single generative AI query takes nearly 10 times the electricity of a traditional search engine query.
10 times. That's staggering when you think about the volume.
Exactly. The big tech companies are planning gigawatt-scale data centers. That's equivalent to powering an entire mid-sized city just for one facility.
Wow.
And they desperately need dispatchable, zero-carbon baseload power to meet their climate pledges. Wind and solar are excellent for the grid, but they're intermittent.
Like the wind stops blowing, the sun sets.
Yeah, exactly. But data centers operate at maximum capacity 24 hours a day, 7 days a week. They cannot afford downtime.
Which really brings up the core tension for anyone analyzing this setup. How do you weigh that immediate, intense cash burn like the billions required to actually build these reactors against a future promise that is still years away from turning a profit?
You really have to look at the structural deficit in the energy grid. We literally do not have the power generation capacity, nor the transmission lines for the data centers currently breaking ground.
We're just tapped out.
We are. And this company is perfectly positioned to fill that specific void, but, understanding the timeline is everything.
Yeah, that kind of long-term patience requires serious financial stamina. All right, let's move into the wealth building context.
So from a wealth building perspective, this is a structural multi-year play. You're investing directly at the intersection of global energy infrastructure and the AI revolution. But, and this is crucial for setting your expectations, the actual commercialization and that steep revenue inflection, they aren't modeled to happen next quarter or even next year.
Yeah, people need to realize this isn't a quick flip.
Definitely not. The real shift happens in 2027 or 2028. That's when their first fuel fabrication facility actually comes online, which is what allows reactor construction to truly ramp up.
And that requires a very specific type of investor mindset. Like you said, this isn't a quick momentum trade where you're looking for a short-term pop on an earnings beat. It requires immense patience.
Absolutely.
You're essentially building a position during the quiet, highly capital-intensive years. You have to be comfortable holding an asset that's going to be spending a massive amount of money to build physical infrastructure.
Right, you're trusting that the structural demand will be there when the concrete is finally poured and the reactors go critical.
Exactly. It really comes down to conviction in the macro thesis. If you believe artificial intelligence scales as predicted, that immense power draw has to come from somewhere.
And the grid just cannot handle it without advanced nuclear.
Exactly. But to survive until that inflection point, we need to see how much runway they actually have. Now let's look at the fundamentals.
So the financial reality right now really reflects that pre-commercial status. They're operating at a net loss, specifically a $22.4 million net loss in the first quarter of 2025.
Okay.
Furthermore, their trailing 12-month free cash flow is deeply negative. It's sitting at negative $85 million. They are burning cash aggressively to build out this infrastructure.
Which makes sense for this stage.
It does. But, however, for a pre-revenue firm, they maintain what you could really categorize as a fortress balance sheet. They have $180 million in cash reserves versus a very manageable $45 million in debt.
So they have the runway to keep building, but they aren't shouldering the financial burden entirely on their own, are they?
Not at all. The top-line trajectory shows the sheer weight of institutional and government backing behind them. They recognized $28.5 million in grant revenue just in Q1 of 2025. Yeah, and that represents a 15% year-over acceleration.
Connecting that back to our space race analogy from earlier. This is where the Department of Energy acts a lot like NASA did in the early days of commercial spaceflight.
Exactly.
The government's Advanced Reactor Demonstration Program actually covers up to 50% of their demonstration costs.
Which is massive.
It is. So while that $85 million negative free cash flow looked daunting on paper, the government is effectively halving the corporate cash burn for their flagship projects. It extends that $180 million run significantly.
Yeah, it gives them so much breathing room.
But, cash is only one part of the equation. What is the underlying mechanism that makes their specific reactors stand out from the competition? Because there are other players in this space.
Right. This is where their unique technological moat comes in, and it requires understanding the physics a little bit. If you look at competitors like NuScale or TerraPower, X Energy differentiates itself by using high-temperature gas-cooled reactor technology, or HTGR.
Okay, let's break down why that matters to the bottom line. Traditional light water reactors, they use water to cool the core and generate steam, right?
Exactly. A standard reactor basically just boils water. But a high-temperature gas-cooled reactor uses pressurized helium gas instead of water.
Oh, interesting.
Yeah, because helium is inert, meaning it doesn't become radioactive and it doesn't boil off. Because of this, the reactor can safely output incredibly intense ambient heat upward of 750 degrees Celsius.
That's incredibly hot.
It is. And that heat is exactly what is needed for industrial decarbonization. Massive operations like hydrogen production or running petrochemical plants, they required intense heat that's currently generated by burning natural gas.
So they aren't just selling electricity to the grid.
Exactly. They can sell industrial heat directly to corporations like Dow Chemical. It drastically expands their total addressable market.
That handles the market expansion beautifully.
Yeah.
But there's also a safety mechanism driving the regulatory side, specifically the fuel design.
Right, the TRISO-X fuel. TRISO stands for tristructural isotropic. Instead of using traditional metal fuel rods that can overheat and melt together, they take a tiny kernel of uranium, like literally about the size of a poppy seed.
A poppy seed? That's tiny.
Yeah, and they encapsulate that little kernel in layers of pyrolytic carbon and silicon carbide. For context, silicon carbide is the same incredibly resilient material used in high-performance brake rotors and ballistic armor.
Oh, wow. So they're engineering the safety directly into the fuel itself, rather than relying on, massive fail-prone external cooling systems.
Precisely.
Because that silicon carbide shell retains its structural integrity at over 1,800 degrees Celsius, and the reactor itself only reaches about 750 degrees.
So the fuel physically cannot melt down.
The laws of thermodynamics simply won't allow it. That explains why it's the only TRISO fuel currently licensed by the Nuclear Regulatory Commission.
Right.
But let me play devil's advocate for a second here. Having the quote-unquote safest or most advanced technology doesn't automatically guarantee market dominance. We've seen superior technology lose out to inferior tech with better distribution before. Isn't the real competitive moat here actually the agonizing regulatory switching costs?
That is probably the most pragmatic way to look at it, honestly.
Yeah.
The technology is phenomenal, but Navigating the US and UK regulatory processes takes years and hundreds of millions of dollars.
It's brutal.
It is. But once a company is fully licensed, that paperwork acts as a massive barrier to entry. A new startup cannot just invent a better fuel design and compete tomorrow. They are 10 years behind on the regulatory compliance alone.
Right.
That bureaucracy is the actual wall keeping competitors at bay.
Which means keeping a close eye on when those regulatory dominoes fall is vital for investors.
Yeah.
That brings us to the catalyst timeline.
So looking ahead, the Q2 2026 earnings are going to be critical for tracking execution. We'll get necessary updates on the capital expenditures for building that fuel fabrication facility, as well as the site prep progress for their industrial project with Dow Chemical. But the massive upcoming trigger is international. The market is waiting on the pending acceptance of their generic design assessment application by the UK Office for Nuclear Regulation.
And for those unfamiliar with the UK process, a generic design assessment, or GDA, means the regulator is thoroughly evaluating the baseline reactor design before a specific geographical site is even chosen.
Right, it's evaluating the tech itself.
Exactly. So if they pass that, what does it unlock mechanically?
It unlocks a massive 6-gigawatt deployment pathway in partnership with Centrica. But, more importantly, it proves to the global market that their technology is viable across different international regulatory frameworks.
Which opens up an entirely new, massive revenue stream outside the U.S.
Exactly.
That's a concrete, schedule-driven catalyst.
Yeah.
But we also have to address the macro environment and the persistent rumor mill out there.
Oh, the rumors.
Yeah.
There are very loud, albeit unconfirmed, rumors of a late-stage power purchase agreement or possibly even a direct equity investment from a massive big tech player specifically looking to power a new AI training hub. Well, given the gigawatt-scale power deficit we discussed earlier, big tech directly funding nuclear development is a pretty logical progression.
It makes narrative sense, sure. But as analytical investors, we have to caution that you cannot build a financial model based on a rumor.
No, definitely not.
What you can model are concrete macro policy shifts. For example, the implementation of the Advance Act in the U.S.
Right, that's huge.
That legislation is specifically designed to slash regulatory bloat, streamline the environmental review process, and provide concrete tailwinds for fast-track permitting. That's a structural catalyst that accelerates their timeline regardless of whether a tech giant buys a stake tomorrow or not.
Yeah, the regulatory environment is aggressively shifting from being a historical headwind into a massive tailwind. The government has essentially realized that national security in the AI space requires localized, abundant power.
The market mechanics are definitely starting to reflect that urgency. Now let's pivot to the chart.
So the technical setup is responding pretty violently to these catalysts. The recent UK regulatory submission sparked a fundamental breakout from what had been a very prolonged, multi-month consolidation phase.
Which makes sense.
It does. The market is clearly starting to price in the shift from theoretical concept to tangible reality. But beyond just the price action, there is a profound momentum signal under the hood here. Granite Shares is currently filing a 2x leveraged exchange-traded fund tied directly to this single stock.
Wow. That is a fascinating development.
Yeah.
I mean, for market makers to launch a leveraged single-stock ETF for a pre-commercial nuclear company, they have to be exceptionally confident in the liquidity.
Absolutely.
Because to run a leveraged fund, the issuer has to constantly rebalance their derivatives at the end of every trading day. You simply cannot do that with an illiquid, low-volume stock.
Precisely. It indicates that the institutional market makers expect massive daily volume, intense liquidity, and sustained, highly active trading interest in the underlying equity. They're building the infrastructure because they already see the trader demand.
And we're also seeing the stock's inclusion on the earnings volatility watch list, which confirms expanding implied volatility and a massive surge in options flow. The derivatives market is bracing for violent moves.
Yeah, it's winding up.
But, while smart money might be positioning for a massive upside squeeze based on these regulatory catalysts, volatility inherently cuts both ways.
It does.
In pre-commercial technology, if an unexpected regulatory hurdle appears, that leveraged ETF and that heavy options flow will accelerate the downside selling pressure just as fast as it would drive a rally.
That binary risk profile is exactly why monitoring the broader institutional consensus is so important right now.
So what does market sentiment look like?
It is overwhelmingly bullish from the top tier. You have major institutions initiating coverage with massive premiums to where the stock has been trading.
Like who?
Well, UBS came out with a $40 price target. JP Morgan initiated at $38. Cantor Fitzgerald also at $38.
Those are big premiums.
They are. And when you look at how they arrive at those numbers, they're using discounted cash flow models that look all the way out to 2030, projecting that steep revenue inflection and discounting it back to today's value.
Interesting.
Furthermore, if you track the insider and institutional flow, strategic partners like Dow Chemical and heavy-hitting sponsors like Ayers Management, they're retaining them equity.
They aren't selling.
No, they are not using the recent breakouts as exit liquidity. That demonstrates deep, long-term conviction from the entities closest to the actual operations.
Well, while the top-tier targets are highly optimistic, I always look for the pragmatic contrarian view to ground the analysis. Not every analyst is projecting a flawless path to commercialization here.
True.
Jefferies initiated coverage recently with a hold rating and a much lower $28 price target.
It's definitely a more conservative approach to the valuation.
It is. It reflects a cautious approach to the execution timeline, projecting revenues 3, 4, or 5 years out in a sector defined by heavy industry and bureaucracy involves layering assumption upon assumption.
Yeah, the math gets a little blurry.
Exactly. The Jefferies rating is a healthy reminder that there's still significant institutional skepticism about whether they can hit these deadlines without massive cost overruns.
Which, given the recent history of the nuclear sector, is an entirely fair baseline to operate from, honestly.
That historical context is crucial. Now let's talk about the risks.
The primary threats are really just unavoidable structural realities of the industry. First is the regulatory and execution timeline risk.
Right.
Historically, securing full nuclear licensing and finishing construction notoriously takes a decade, sometimes stretching far longer. Just look at the delays and cost overruns of the volatile plant in Georgia.
Oh yeah, that was a mess.
Right. So any unexpected delay with the U.S. regulators or a rejection of that generic design assessment in the U.K. would completely crater the stock's premium. The current valuation relies entirely on hitting these aggressive deployment timelines.
And the second major risk is capital dilution. Like we said, they have a $180 million cash runway right now, which is great for keeping the lights on and paying the engineers.
Exactly.
But to fund multi-billion-dollar reactor construction down the line, they will almost certainly need to tap the public markets to raise more capital.
Yeah, it's inevitable.
And the mechanics of equity dilution dictate that if the stock price isn't high enough when they need that cash, they'll have to issue a massive amount of new shares, which dilutes the ownership percentage of current shareholders. It's essentially a race against the cost of capital.
Those are heavy realities, for sure. But there are mitigating factors baked into the current landscape. If you look closely at that conservative Jefferies $28 target, it suggests that the dilution risk is actually already largely priced into the stock by the market's more cautious models.
So the street knows they'll need cash eventually.
Exactly. Furthermore, the step-by-step execution we're currently seeing in the UK, combined with the streamlining mandates in the U.S. Advance Act, they are actively shrinking those dreaded historical timelines.
Right.
The legislation is specifically designed to prevent another decade-long delay from happening.
So with everything on the table, what's the final verdict?
Well, based on the underlying analysis and the current macro setup, it earns a bullish score of 8 out of 10.
Okay.
This company is positioned as the undisputed leader in high-temperature, physically meltdown-proof nuclear technology. They're actively building an insurmountable regulatory moat, and driven by the unprecedented, desperate power demands of the AI revolution, it offers highly asymmetric upside for investors positioned in the clean energy sector.
To synthesize a clear multi-year investment view for you, this is a long-term horizon play. The data suggests an absolute minimum of 3 to 5 year horizon.
Yeah, don't rush it.
Right. That means investors must be fundamentally prepared to weather severe inherent volatility, hold through upcoming binary regulatory milestones, and wait for the 2027 or 2028 facility operationalization to actually capture the modeled value. You're effectively buying the foundational infrastructure of tomorrow, today.
Couldn't have said it better.
But before we wrap up, here's a final provocative thought to mull over based on the data we discussed. If big tech companies, the Microsofts, the Amazons, the Googles, continue to face gridlock and begin directly acquiring or taking massive controlling equity stakes in nuclear developers just to guarantee power for their data centers, what happens to the industry?
It's a great question.
Does a company like this eventually become a traditional public utility, serving the broader grid? Or does it essentially become a privatized tech infrastructure arm, entirely walled off, generating gigawatts of power exclusively for artificial intelligence?
It's going to be fascinating to watch unfold.
Definitely. If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount. And Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results. And you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.